Many people tend to shut down when someone starts talking about accounting, but it's important that small business leaders understand and even embrace basic accounting concepts. Accounting is how we summarize the financial information of a company to inform decision-making, set goals, and track many financial metrics. Entrepreneurs and business professionals also use accounting information to communicate a business's performance and financial position to potential investors and lenders. My name is Dr. Sid Bundy, and I'm one of the accounting professors at Tennessee Tech University. I'd like to spend the next several minutes talking about some of the basic accounting concepts that every business person should understand. Learning about accounting can empower you to join the conversation about your business's financial performance and make better data-driven strategic and operational decisions. We like to say that accounting is the language of business. You'll hear that a lot. And it's true, accounting provides a common way to measure and communicate a company's financial projections, their goals, and their performance. It's important for managers and small business owners to be fluent in this language, as well as anyone in the marketing field. Like any language, accounting has its own vocabulary and its own rules. I want to cover a little bit of the history and vocabulary before we go any further, and then we'll discuss those rules. In 1494, a friend of Leonardo da Vinci, his name was Luca Pacioli, embedded a chapter in his math textbook that standardized the double entry accounting system that Italian merchants were using to record transactions across the eastern trade routes during the Renaissance. His 530-year-old book is the reason you may have heard the terms debit and credit in relation to bookkeeping. Debit and credit refers to the left and the right side of accounts. The left side of an account is called the debit side. The right side is the credit side. The debits and credits of bookkeeping don't have anything to do with Visa and MasterCard or your bank ATM card. If you want to record something on the left side of an account, you debit it. That's it. Pacioli taught us to use these debits and credits in double entry accounting to record the individual financial events as they happen. We call these financial events business transactions. Transactions are first recorded in a journal by date and then posted to a ledger by account title. So when we say bookkeeping, we're talking about two books, the journal and the ledger. Once upon a time, these were physical books. You can think of those bound volumes that you might have seen in Harry Potter from Gringotts. But now these books look a lot more like computer databases, and they're moving toward blockchain. When we talk about accounts, we're talking about groups of transactions summarized by type in the ledger and journal. There's nothing magical about the names of individual accounts. Companies just prepare a list of accounts that they're going to use. This is called the chart of accounts. Every account that's listed in the chart of accounts will have a name and its ledger. For example, a business's main checking account might be called cash in the chart of accounts. And the account that records a fleet of cars might be called vehicles or equipment or even fleet. The name isn't all that important. However, each account is classified into a specific category, and there are 5 major categories these accounts could fall into: the assets, liabilities, equity, revenues, and expenses. The categories will determine how the accounts are going to be treated and where they'll show up in the financial statements. This is probably a good place to say that the idea that assets minus liabilities is equal to equity forms the foundation for the double entry accounting system. We call this formula the accounting equation. It's assets equal to liabilities plus equity. The accounting equation is represented in the statement or report called the balance sheet. This is where we show that all the company's assets are either financed by debt or by equity. This is something known as the company's capital structure. We also use the balance sheet to talk about a company's financial position based on working capital, which is the difference between certain assets and liabilities. Of course, there are subcategories to these 5 major categories. Assets can be broken down into current assets, property, plant, and equipment, and intangibles. Expenses can be called cost of sales or operating expenses or SG&A, which is sales and general administrative expenses. Not every company uses all of these subcategories though. With a little bit of history and vocabulary under our belts, we can now move on to the rules. The rules ensure that the accounting information that we share is relevant, reliable, verifiable, timely, and comparable. For large public companies, those rules are known as GAAP, the Generally Accepted Accounting Principles. Accounting rules aren't always black and white. They're more like guiding principles. GAAP provides guidance for estimates and allocation systems. In a lot of places, the rules allow for choice between several alternatives. But all of the alternatives are systematic and follow overall principles for high quality information. Again, those principles for high quality information, what makes information high quality is that it's relevant, reliable, verifiable, timely, and comparable. Although they aren't required by the SEC, many smaller private companies prepare their accounting records and statements according to these principles because GAAP financial statements are often required by lenders for grant funding and in federal and state contracts. GAAP statements also allow you to compare your financial results to larger companies within your industry, so you can benchmark. Under GAAP, companies use the 5 types of accounts to summarize their financial information into 4 specific statements: the income statement, balance sheet, cash flow statement, and a statement that summarizes any changes in equity. Companies may choose to prepare a formal report that includes these 4 statements monthly, quarterly, or annually. Luckily, much of the tedious work that you might imagine being done by Bob Cratchit or the goblins at Gringotts are automated these days. Most small businesses use specialized software like QuickBooks, NetSuite, Wave, or FreshBooks to assist them in writing checks, in sending invoices, in managing accounts receivable, running payroll, tracking sales tax, preparing bank reconciliations, tracking inventory, and scheduling resources for efficient project management. Regardless of the software used, GAAP financial records go beyond keeping up with the business's checkbook. That's not to say that the inflows and outflows of cash aren't important. They definitely are important. And it is of course necessary to manage the flow of cash. You have to meet your bills in order to stay in business. However, financial reports prepared on the cash basis may give a less accurate view of a company's financial position and performance. That leads us to accrual accounting. Accrual accounting is all about timing. By recording revenue when it's earned, not when the cash is collected or received, and by matching all of the costs associated with earning that revenue in the same time period, we can give a more accurate picture of how a company turns a sale of goods or products into income. The accrual basis of accounting requires this kind of revenue and expense matching. In order for that matching to be able to happen, GAAP introduces 4 types of accrual and deferral accounts. These are receivables, payables, prepaid expenses, and unearned revenues. It doesn't matter if you know which of those accounts are deferrals and which of them are accruals, but you need all of them to adjust the timing to appropriately match revenues and expenses to the period that the work is actually done. The gold star for the 4 financial reports or statements is to prepare them using double entry accounting on the accrual basis following the GAAP principles. Accounting offers a great opportunity for a career, and I encourage you to seek out information about an accounting career, whether that's in the field of bookkeeping after high school, through a 2-year program at your local junior college, or through a 4-year degree at an accredited university. I encourage you, if you are a business leader someday an entrepreneur, or if you're in the marketing field, I would encourage you to seek out a CPA to serve as an advisor and valued part of your management team, not just as a tax preparer. Sit down any dread you may feel about the prospect of spending time with a dry or boring stereotype. You may be surprised to learn that all accountants aren't introverts. We are people. Robert Plant, John Grisham, Mick Jagger, and Janet Jackson rank among some of the well-known accounting students. In fact, if you're interested in becoming a financial expert and learning more about accounting, reach out to the accounting department at Tennessee Tech University, and we'd be happy to point you in the right direction. Of course, CPAs can also help you with your sales taxes, your payroll taxes, estimated self-employment taxes, and bonus calculations. But they have so much more to offer as a go-to financial expert and advisor. Really talk to CPAs about how accounting information can be set up in dashboards to track key performance indicators that will help you make better strategic and operational decisions. Come to them with supply chain, financing, budgeting, and expansion questions. In short, don't be afraid to ask questions and learn more about accounting. We can help you grow your business.